Good evening, ladies and gentlemen. This is Barry Norman on behalf of Investing.com and CMS Trader, and welcome to our class on IPOs. We'll be getting started in just a minute. I'm going to give the last one or two people a second to get started, and we will be getting ready right on the hour. I hope everybody had a very nice holiday weekend, no matter what you were celebrating or why. It's springtime and we're all getting ready to enjoy the spring and get ready for summer. And we're also moving into IPO season. Now tonight's class is sponsored by Capital Markets Trader, CMS Trader, which is one of the leading online platform providers. And if you go to www.cmstrader.com, just click on the buy or the sell button and you can, in 4 lines, open a demo account. Doesn't require any credit card information, any personal information, doesn't require any data, and it doesn't require you in. And then you can start trading on their demo platform and see how good it is to trade with one of the more advanced trading platforms out there. When you trade with CMS, you can trade commodities, currencies, stocks, and indices. But CMS is a regulated provider, so I'm also required to give you a risk warning before we start our webinar. Trading Forex, CFDs, and spread betting on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risk and take care to manage your exposure. So once again, if you go to www.cmstrader.com and click on the buy or the sell button, either here or here, it's going to open up a little window for you to put in your personal information. No credit cards are required, no deposits required, and you can start trading right away on the demo platform. And you can see how easy it is to trade with CMS Trader. And also they offer a very broad range of education you can take advantage of. And they have all types of features and all types of accounts that are designed to help both the novice trader and the experienced trader to make sure your trading is fast. They have multi-language customer services so that you can always be addressed in the language you're most comfortable with. They'll give you free signals, free market updates, a technical analysis, everything you need to become a successful trader. You can trade a very wide range of instruments when you're trading with CMS Trader. And you can use their watch, copy, and profit, their social media screen, and just copy trade along with other successful traders in just one click. So you have many varieties. And again, they have great education facilities, so they'll turn you into the best trader that you can be. So let's get started with our class on IPOs. Now, an IPO just stands for Initial Public Offering. Now, even though we see all kinds of headlines when a big, especially tech IPO comes up, we saw everything flashing a couple of weeks ago on Snapchat. Before that we had Uber, we've had, we had Facebook a couple of years ago. These all make the headlines, but there's lots and lots and lots more IPOs going on in the marketplace all the time. But many, many people only are aware of this or get captivated when there are very broad headlines. But getting involved in an IPO, or for a company to decide to issue an IPO or go public, is a big critical decision that takes a long period of time. So going public is a monumental decision for any company. It forever changes how a company goes about doing business. A public company has access to more and often deeper sources of capital than a private company. The actual process of going public can be time-consuming and present certain unique challenges that a company should be prepared to undertake. So when you read about a company thinking about taking an IPO or predicting an IPO, they are going through the decision-making process, the paperwork framework, the regulatory framework, which could take months or as much as years. I mean, we have a big one coming up soon, which will be the Saudi Arabian oil company going public, but it's taking, they announced that almost a year ago, and we still don't know when this will take place. So an initial public offering is a transformational event for an organization. The preparation for being public is just as important as the preparation for going public. A company will need to meet additional requirements and continue obligations of a public company that may require a completely new skill set, additional resources, and change to business. A lot of times there's lots of things that go on behind closed doors before an announcement is even made that they're thinking about going to IPO. You'll see a change in management structure. A lot of times you'll see changes in CEOs, see changes in department heads, changes in directors, because now they're looking for the proper resumes and the proper picture to put forward in a possible IPO. Thinking through these requirements in advance and developing an appropriate plan is a key to a successful entry into life as a public company and will reduce unexpected post-IPO issues. Now, yes, when we see Snapchat, when we see Facebook, when we see PayPal and eBay doing what they did, when we see all of these things happen, these are big companies with huge amounts of resources. Okay? But there's lots and lots of companies going to IPO that are very small, and I'm talking about small in the scale of compared to a tech company, but the cost of going to an IPO can be overbearing, or the types of reporting after they go to an IPO can kill their stock price. Lots of having to function in this framework can be difficult. So there are many decisions that a company has to make. What does going public mean? It is a process of offering securities, generally common stock, of a privately owned company for sale to the general public. The first time these securities are offered is referred to as an initial public offering, or IPO. Now, an IPO in which a company sells its uninsured securities and receives all the proceeds in the form of additional capital is called a primary offering. A security sale in which securities held by the owners of the company are sold and from which the owners receive the proceeds is called a secondary offering. So there are various variations of these, because a lot of times when you hear about these guys becoming billionaires overnight, is because they actually sold their shares. There's other cases, like say for Facebook and Mark Zuckerberg, they sold the unissued shares, but the value of shares retained by Mark Zuckerberg then had a current public value, and the value of those shares was worth billions of dollars. Now, the most important question a CEO should ask is, why do I want to go public? Some of the reasons include to access capital markets to raise money for expansion of operations. 2, to acquire other companies with publicly traded stock as the currency. 2, or next, to attract and retain talented employees. One of the best benefits a growing company can do is if they're a publicly traded company, they can offer their new employees stocks and options in this company. You can't do that when you're not a publicly traded company. You can have some sort of profit sharing, but nothing as far as ownership, like, you're not going to hire somebody new to work in your development department and tell them you're going to give them 1/10 of 100% of the company, because it's not a public company. But you can sure tell them you'll give them an option for 100 shares every year. So that's one of the main reasons, surprisingly, that companies will go public. They also want to diversify and reduce investor holdings. So say, for instance, while you were growing, you needed to raise some capital. So you got an investor and he put $1 million in your company. He now would like to see his $1 million out. He wants to cash out. Not sell it all, but he needs his cash to invest in other things. Company's doing well. He's happy, but he wants his cash back. So, or he wants to reduce, or he wants to, he wants some liquidity. So he wants to be able to sell some of his holdings. So by going public, he can then reduce his investor holdings or his shares become more liquid. It also enhances a company's reputation. When you're trading on one of the major exchanges around the world, since everything's covered by regulation and all the reporting is all done because of laws and regulations, you feel safer doing business or being involved with one of these companies. So other reasons may be private and personal. It is important to keep specific goals in mind when you go company. So when a company is going public, you have to understand why. What is the reason for this particular company? Again, we get lost on these IPOs because we get tied up in these big news headlines. And I'm going to show you shortly how many companies are just scheduled to go to IPO in the next 60 days and where you can track these companies. And we're also going to talk about how you can cash in on potential IPOs. Okay. Now, one of the most important questions that a CEO or the board of directors has to ask itself is, has your company reached a point at which prospects for maintaining a strong sales or earnings growth trend in the future are reasonably good? Many companies that have successfully gone public have illustrated market support for their products and services that would sustain an increase of annual growth rate over a period of time. Because you don't want to go to an IPO, set a price for your shares, then the market doesn't buy them up, or there's lots of failure at IPOs, or there's lots of IPOs that go public and their shares aren't bought up. I recently saw a company, a tech company, that went public and they only sold a couple $1 million worth of shares, half of what they were expecting. But now they have all of the regulatory requirements, okay, and it's become a burden on that company. You wouldn't have wanted to invest it because guess what? The company's now sitting with a lot more shares than they ever thought they would. So are your company products and services highly visible or of interest to the consuming or investing public? The established company can answer this question with historical sales data, while the early stage company must use market research projections and demonstrate product superiority. Okay. Now, is leadership capable and committed? In any public offering, the quality of the leadership team is a key factor. It is vital to ensure that the board of directors, as well as the management, has the right blend of experience and skills to establish the optimal corporate governance structure and ensure that the board committees are operated effectively. Because what happens is, a lot of times, a company starts out as a mom and pop, or starts out through a startup mechanism where the original owners or investors are, the owners of the company. They become the CEOs or the CFOs, the VPs of marketing, but they don't have the credentials for a publicly traded company. And this is a point where when they decide to go to an IPO, that a lot of times, a lot of the initial staffing is pushed out the door because they need now the right credentials. And what happens is this new management team may not be able to lead this company effectively as the initial startup company. Now comes a big decision. Each stock market has specific entry requirements, such as earning history, shareholders' equity, market capitalization, number of expected shareholders, and corporate governance. A company seeking to go public must choose the market that is right for its stock. A company's banking advisors can furnish in-depth information on the investor's base for each market and the market's likely appetite for the company's shares. A company and its advisors should approach the stock market early in the capital raising process to ensure the smoothest possible transaction. In other words, you don't just decide in the morning, I'm going to be listed on New York Stock Exchange and they're going to have room for me, or they're going to put me up there This is a long process. There's big costs involved. There's different requirements, whether you're going on the NASDAQ, whether you're going on the DAX, whether you're going on the CAC, whether you're launching in the FTSE, whether you're launching, and you have to find out what their regulatory requirements are, what their overall process is, what their policies are, and decide if it's the appropriate place for your shares. Like most of us know that most tech companies go with NASDAQ. A lot of people were shocked when Alibaba went with the US. Okay. All of these are very important, concerning features that have to be taken into consideration. Now, there's also all types of alternatives to IPOs. Okay. So before we decide, there's another thing we have to decide, when we're going to go public. A lot of times you hear companies announce that they're going to go public, but they're going to, and then some of you say, what happened then? When they made an announcement a year ago, they're going to go public. Well, they're waiting for the market to be hot for their type of thing. Markets go through cycles. IPOs go through cycles. So hot markets accept many offerings, but companies do not want to deal with just one day too late. Recognizing the urgency of the registration process is critical. Even in a slower market environment, there is what is referred to as the industry pop or industry flurry. Industry pops are tricky since some IPOs may be perceived as me too, like you're following along. Like right now, if some other social medias pop out there, they're going to say, oh, they're just following along behind Snapchat, riding on the coattails. But also, right now, social media and tech companies are very hot again. So if you're in a tech industry, you would want to be going when the markets are hot and the investors are looking for other alternatives within that same sector. So this is something when we want to look to invest, because we have to understand IPOs before we get involved in investing, because we need to pick and choose which stocks, when they come on the market, we would want to get involved in. Okay. And there's also other ways to get involved in these stocks. Now, as I said before, there are IPO alternatives. So a lot of times, you've actually seen recently some companies go reverse back to private sale, where all their shares are bought up and they're taken private again. We just saw that, I think in the U.S., one of the big food companies, Chipotle, might have gotten a reverse. Somebody went in a reverse sale just recently where it was bought up and taken back to being private. A successful IPO Okay, somebody just asked me, how does the company make out of selling shares? The company really doesn't make money by selling shares. They raise cash. If hypothetically Facebook had 1 billion shares, or say Apple, before they went public, had 1 billion shares of stock issued, in their corporate paperwork, and this early investor who put up money for back in the startup, he got 100,000 shares, and this guy got 1 million shares, and they're still sitting with 500 million shares. Those 500 million shares have value, but until you take it to IPO, you can't really raise cash, because they can't sell them except to big institutional investors. By taking that business to the public markets, they can now sell those stocks off them. So all they're doing is raising cash. And that cash can be used for them to grow their business. Now, if the stock goes up higher than it was estimated, like Facebook, remember when Facebook came out, there was an initial thing, it fell right after its initial release, but then it soared. So what happened was the company keeps making money on the shares they're holding, plus of course marks, because the market value goes up. So there's no different than when you make money. If you bought shares in Facebook, you made money. Well, so did Facebook buy all the shares they're holding. So did Mr. Mark Zuckerberg, because the value of that company went up. But they're not selling anything that they're making profit on, so to speak. So the decision can go public can be one of the most important ones in a company's history. One of the most compelling challenges. A company needs expert direction and assistance to stage a successful IPO. The company will have an opportunity to select many of the participants in the IPO process. No offering of securities, either orally or in writing, is permitted before the registration statement is initially filed with the SEC. These rules are very strict. A company must be careful not to generate undue publicity about itself that could be construed as an attempt to stimulate interest in its securities. So when you're getting ready to go to an IPO, you have to be very careful. You can't, yes, you want press, but until you've actually filed your initial paperwork with the SEC, you can't indicate that anything's for sale, and you cannot sell anything. Okay. Also, once you filed your paperwork, you can't sell anything either. Until that IPO is issued, there is no sale of stock. Okay. After the initial filing, however, and concurrent with the preparation of the amended registration form, SEC regulations do permit certain types of promotional activities within the brokerage community, such as those noted. Now what happens is, because these companies would like their shares to be very well received, and they want the hype, they want the headlines, they want the demand, because this also helps them bring in, this is way before they're getting ready to be issued, but this helps them get the investment bankers interested. So a preliminary perspective at this point may be sent to interested institutions or persons prior to the effective date of the registration statement. This preliminary prospectus is the key tool to lead underwriters' ability to form an underwriting syndicate made up of various brokerage companies that will distribute the stock. Because a company needs a middleman. A company's not in the business of selling their stock. So they deal with the underwriters and the investment banks, who then sell it off to their people, because a company, even Facebook when they were big, or Snapchat, they don't have any dealings with the general public. They don't have any general dealings with buying and selling shares. They use underwriters and investment companies. So what they do is they actually issue a report at this point, which is known as the red herring. The red herring is, again, it's full of honest facts, but it's done to perpetuate or build up momentum in the idea of this company going public. Then they actually go on what's called roadshows. They go from investment banker to underwriter, trying to build up all types of interest, because they want these investment bankers and these underwriters to start pushing or pre-selling these shares to their investors into the public market. They can't sell anything, they can't issue anything, but they can get commitments, or they can get everything prepared. So this is what you remember when you were seeing Snapchat, all being talked about weeks before they went public, because you don't even know what day they're going public. Now this can be a very grueling process, since the span of time can last up to 2 weeks with a number of presentations a day, but it goes by relatively quickly. By the time the registration statement has been filed, a company and its underwriter have generally agreed on the securities, both in the number of shares and the dollar amount to be sold. However, the final price at which they offer the securities to the public, the exact amount of the underwriter's discount, and the net proceeds to the resident have not yet been determined. The negotiation and final determination of these amounts depend on many factors. That's why, if you remember as recently as Snapchat, nobody had any idea what prices would actually physically come to market on the day it starts selling, because that is when the price of the share is established. When the underwriter starts selling through the exchange publicly, and that establishes then a price, and then the shares go up and down from that price being traded publicly. So in establishing an offering price, the underwriters will look at multiples of earnings and cash flow based upon experience by similar companies. Then the closing date, generally specified in the underwriting agreement, is usually within 3 to 5 business days after the pricing of the offering. At closing, a company delivers the registered securities to the underwriter. Once he receives them, he can then take them to the exchange. But he must receive them, okay? And they must receive payment for the issue. Various documents, including the bring down letter prepared by the independent accountants, are also exchanged. There's lots of formalities. An IPO gives the investing public an opportunity to own and participate in the growth of a formerly private company. By their nature, however, IPOs can be risky as speculative investments. Now, again, it's very hard for me to get people to stop thinking about Facebook and IPO. There are thousands and thousands of listed public companies. Okay? Most of these get no hype and no hoopla, but these are the ones that you can invest in. These are the ones that you can reach. These are the ones you can buy the shares in easily and that make good long-term investments. Now, there are two ways the general public can invest in a new public company. First, if you are a client of an underwriter involved in the IPO, you may be offered an opportunity to directly participate in the IPO. Now, this is one of the reasons a lot of traders or investors open multiple accounts and open fairly large accounts with people like JP Morgan and Chase and the bigger investment and underwriters, because this will give them an opportunity to take place in some of these IPOs via their where their accounts offered. Okay. In instance, you will be able to purchase the shares at the offering price. It is often the case that underwriters and dealers will distribute most of the shares in the IPO to the institutional and high net worth clients, such as mutual funds, hedge funds, pension funds, insurance companies, and high net worth individuals. But once you have an account with JP Morgan or one of the big, whoever's underwriting those shares, you can ask them to let you participate, even though you're not a multi-billion-dollar trader. But having an account, because what happens is those shares are sold technically to JP Morgan Chase, who's then pushing them out into the market and has a responsibility of selling them all. But they don't want to go out. They're not there going to call door to door to door to door. They're going to sell them out to their institutional investors. You know, the hedge funds, the guys who can, and so you're always saying, who's buying up all these shares? Well, if you happen to be with one of the big companies, you might have an advantage. For a typical investor, being able to directly buy in a popular IPO is a unique opportunity. The second, or the other way, which is more common in the case of individual investors, is to purchase the shares when they are resold in the public market the days following the IPO. An investor can place an order with his or her broker to purchase the shares in this manner. Okay. Now the question is, how do you learn about all these? Because chasing down the Facebooks and the Snapchats aren't worth the time and effort. So there are many ways that you can learn about what is being offered, because they all have to go through the regulatory process. You can start learning about them way far ahead of time, before they're ready to go public, okay? Because they have to issue their regulatory and their letters 20 business days after the registration statement is declared effective. So, and even though you're not an institutional investor, all you have to do is contact the company and ask for a copy of their financials, and they will be more than glad, or by law I think they have to send them to you. Being well informed is critical in deciding whether to invest. Therefore, it is important to review the prospectus and any questions when researching an IPO. Whenever possible, verifying the information you are given against independent sources is also recommended. If you buy directly in an IPO, you will receive a copy of the prospectus before your broker confirms your sale. But you can also read the prospectus before then by reviewing the prospectus, including the company's most recent filing. Now, again, because there are so many small companies out there coming to market, it's the smaller companies will be more than glad to talk to you, give you give you the perspective. Even in your broker will be more than glad to discuss these with you because they're looking to sell these shares because they're not being bought up like Snapchat or Facebook or eBay or PayPal when they came to market. These have slower movements, but you need to understand exactly what you're investing in. But right now, I'm going to take you over to one of the best places you can get all this data ahead of time. And this is right on marketwatch.com. And let me pop it up on your screen. So if you go to marketwatch.com and just go to under tools and look for the IPO calendar, you can see the recently priced IPOs. We can click on here's the upcoming IPOs for just next week. Next week we have 1, 2, 3, 4, 5, 6, 7, 7 coming this week, 1, 7 next week. We have future IPOs. Look at all these that are scheduled for coming up in the future. All of these are companies that we don't know about. They don't make the big headlines, but you can invest in them. Okay, we're looking at shares coming out at $10, $6.23, $5.37. Okay, all of these can be had through your broker. Okay, you can also go over to, you can see how many were canceled because it was most of these times it was either lack of interest or the markets weren't in the mood for them right then. Okay, so there's tons of IPOs that you can become involved in. And you simply contact them or your broker directly. So if you want to go to, say, here, China Rapid Finance, click on there. It's going to open it up and give you all the data they have, but it's not traded yet. So you can contact them. We can see here the SEC filings, and you can contact them directly and ask for a prospectus. Okay, and they'll give you the full prospectus and get all the information, to you about the company. Everything's been filed with the regulatory bodies and everything else, so that you can then start making a decision. But this is your job to do, is to research them all. And this is just basically U.S. markets. There's also, again, European markets, Asian markets. Okay. And so there are many, many, many companies coming by IPO or bringing the IPO. The small companies are good, solid investments. If they're coming public, they've raised a lot of money, and they're looking, they're solid companies, and they might be very good long-term investments or have very good possible profit levels for you. So you need to spend a little time doing the research. Okay, so what else can you consider? Following are some things to consider when making investment decisions involving shares in new publicly companies. So the company underwriter makes the decision on where to set the offering price. The factors they consider in setting the price, as well as the terms of the underwriting agreement between the company and the underwriters, are discussed in the prospectus. Usually under the caption underwriting or plan of distribution, it is important to understand that the offering price is determined by a mix of market conditions, analysis, and negotiations. Competing interests affect the determination of the offering price. So in other words, when you look at Facebook or Snapchat recently, it's what will not just what will the financials and the perspective say it should be, what is the demand from the public? When the public is willing to buy, because they're trying to figure out what price will the public continue to buy as we take this IPO. The trading price of a new issue may be affected by limited supply of shares in the market immediately following the IPO. The shares being traded on the first day are generally only shares that were sold in the IPO. All other outstanding shares, such as those held by founders, early investment employees that have not been included in the IPO, may often not be sold to the public so soon after the IPO, either because they are restricted securities or they want to sit on them, or there's a lockup agreement. In other words, a lot of times, any of the the employees or the CEOs of the board of directors holding these shares cannot sell them for 180 days. Because what you don't want is somebody getting in a lot of hype, getting all the shares to come public, and everybody, all the concerned people from the board of directors, CEO, sell off and have no interest in the company anymore. So this is prohibited. An increasing number of companies engaged in IPOs have created separate classes of common stock, which one class has greater voting power than the class being sold in an IPO. And this is something you need to watch for. If there's an IPO, are they classifying or reclassifying those shares? Very recently, Snapchat did this. Okay, Facebook also did this. Now, it's not against the law, but you need to be aware of what they're doing. They didn't do this after you bought the shares, but they created a new class of shares. Snapchat, all those shares that were sold in the IPO had no voting interest. So they have very little say in what the company's doing. This has become a new class of stock. So they have dual class of common stock. This dual class of common stock structure is often used by companies that are family controlled or will continue to be led by their founders, with the super voting common stock held by the founders or controlling family. With this structure, the holder of the super voting common stock has a much greater percentage of the voting rights in the company than his or her equity stake would otherwise promote, and can control the company without owning a majority of its shares. Generally, the super voting common stock converts to the lesser voting common stock when sold by its initial holders. So in other words, when Walmart went public, Sam Walton could have held on to his super voting shares, but once he sold his shares to the public, they no longer kept that super voting share because he wanted to keep his company in control. But once his family started selling up those shares, they could then lose the overall control of that company. Snapchat did something very similar. Now, recently, the head of the SEC in the U.S. said more investors should be able to buy stakes in closely held startups. And we're going to see some changes coming up soon to open up the markets, especially with Trump in office and his deregulation, opening up the abilities to more of us to get involved in IPOs as opposed to just keeping them restricted to big investors. The Securities and Exchange Commission should allow more investors to buy stakes in closely held startups such as Uber or Airbnb or Lyft. The agency's chairman recently said, Michael Pinawar, the SEC's acting head, said the commission should consider altering restrictions that would lock out investors with only moderate wealth. He said the standards which limit such private deals only to well-heeled, accredited investors don't serve the intended purpose of protecting those people from the potential risks of putting money into higher risk investments. Currently, only individuals who meet certain wealth or income standards are allowed to invest in private stock offerings. These are issued outside of the public market by companies. These range from stakes in startups to hedge funds offerings. And so we're going to start to see more and more ways, because we have crowd sharing, which has become so popular that it's almost like becoming an IPO, a way for a small company to bring in private investors. Okay. So we're going to see the U.S. market start opening up to a broader range of small investors being able to get involved in these. But when you do, you need to understand exactly what you're getting involved in. But it will just open up another alternative, especially for longer term investing. So thank you very much for joining us tonight. We'll talk to you again real soon. And thank you for being part of the CMS Trader family, as well as supporting investing.com. And again, go to www.cmstrader.com and sign up for a demo account. Give them a try. Try it, play with the demo platform, see if you like them, and maybe you get an account open there. Thank you very much and have a great spring season. Bye now.